mortgage payments. But instead, we suspend those payments and we take equity or interest out of her equity each month, and thus the very first reverse mortgage was born. Now, why do they have a bad reputation? Well, for 27 years, the reverse mortgage industry was unregulated. So you have all these companies out there doing some form of a reverse mortgage. And honestly, Carly, some people were taken advantage of. Some people lost their homes, which is really sad. But it hasn't been that way since 1988, when Congress and President Reagan got together and passed the Home Equity Conversion Mortgage Bill, HECM, HECM, and it was designed to allow a senior to remain at home, retain title of ownership, maintain their independence, entertain the lifestyle they've worked for, and gain access to their equity and refrain from having a monthly mortgage payment. It was a trial bill for 10 years. They only did it for 10 years to see if it would work. Then the law was made permanent, and over the years they've improved it and made it even better, made it even safer for people. And so now here we are, 2025, and 89 is when the first one came. It's 36 years of history it's been around. And so one of the reasons I wrote the book that you mentioned is reverse mortgages have such a bad reputation, such a bad connotation out there. But why? Because of the history prior to when we started regulating them. And so I just wanted to let people know that, this isn't bad, this is good. And it benefits people to learn about it, whether they ever do one or not. It's good just to learn how it works.
Sure.
So this is actually your question. I'm going to actually finally answer your question. How does it work? If somebody, it has to be in the primary home, they have to maintain it, pay the property taxes, insurance on time. As long as they do that, the term they can't outlive, 150 years. So that's it in a nutshell. It's just a simple way to allow somebody not to have a monthly mortgage payment if they have enough equity. And I have a fun story about the very first person I helped if you want to hear it.
Of course I do. You're a storyteller. Tell us the story.
Well, the very first lady I helped was referred to me by her daughter. She was 84 years old. Her name was Carmen. She's about 5 foot nothing, just full of fire, a lot of fun. And I asked her, I said, "Hey, Carm, how come you want to do this?" And she said, "Well, my budget's tight." She was just living on Social Security, lived in a duplex, so the side she rented paid the mortgage, and then she had her Social Security to live on. And I said, "Yeah, I get that. Tell me a little bit more about that." She goes, "Well, honestly, I'm using credit cards to buy groceries." 84 years old, doesn't have enough money.
Yeah.
And this was 2015. This was before inflation. We didn't really have inflation very high back then.
Right.
But the bottom line is she didn't have enough money to live on. So long story short, we're at the closing table, and I said, Carm, I know the math. I know how much we're saving with the mortgage payment, how much we're saving paying off the credit cards. It's about $1,100 a month. I said, I know the number. But tell me how this is going to change your life. She kisses me on the cheek. I had to go home and tell my wife who got kissed by an 84-year-old lady at closing. Kisses me on the cheek, and she says, "Well, this is going to change my life because I can sleep at night. I won't have to worry about money." So just imagine if you're a senior and you're on a fixed income, you see prices going up all around you, gas and eggs and all this stuff. Everything's more expensive every year, and you're getting this measly increase on your Social Security, and that's all you have maybe, or maybe even a small pension if you're fortunate enough to have a pension, or some savings or some investments. But the bottom line is your whole life used to money coming in with work, and now you're not working anymore, so money's going out, money's going out, money's going out. And you're concerned. You're thinking, man, do I have enough money? Am I going to make it? Am I going to run out of money? So what a reverse mortgage does, it just gives people options outside of their wages or income or assets and investments, tap into equity. It allows everything else to last longer.
And so would you say that among your many clients that you've had, is there a certain profile of the type of person that you've been able to help with a reverse mortgage?
That's a great question. There's really, I'd say, two categories of people. The first one is like Carmen, the need them. She has to need them. she happened to really need it. She's running out of money, and unfortunately, that's a lot of our population. This loan is kind of seen as a last resort. Well, I'm broke, I'm out of money, I might as well do it, or I better do it. So I would say the desperate people or the people that are out of money is one category. Then there's the not need them, and I'm finding more and more of these people that are finding me because I'll tell you about Grandma Pat. Grandma Pat lives in Grand Junction, has her house paid off, and has enough money to live. She just sold her business. She's doing great. So I said, "Hey, Pat, what's going on? How come you want to look at this?" She goes, "Well, I was a single mom. I raised my daughter, and now my daughter's a single mom. I have 3 grandsons, and I want to make memorable occasions or events or vacations
Memories.
with them."
Mm-hmm.
Yep. So she said, in fact, this next month, I helped her earlier this year. This June, they're going to Turks and Caicos for like 3 weeks.
Nice.
And she's taking the boys. It's just Grandma Pat and the boys. And she goes, "Yeah, my grandboys just think I'm the best grandma ever because I do all this stuff with them." Because now she has money. So think of it this way. We're all going to give our legacy, our estate, our inheritance to somebody at some point. We can give it with a cold hand when we're not here, or we can give it with a warm hand while we're still alive. Well, we can be a part of it and see the good that can do. And I've had so many people over the years. They've bought second homes. They bought businesses. They've helped their grandkids or kids with a down payment on a house. They've given money to charity, right, while they're still here. So that's the 2 different clients I see as kind of the person who really needs to do it, and then the person who just wants to do it because they want to enjoy the benefits of giving while they're still here.
So we have time for one more question because I know we're going to already have a part 2 and part 3 because we could dig into this a lot more. But in this first time that we have together, can you explain kind of the mechanics? Let's talk about like that person that wants to do this. They, like, for example, as you probably know, there are people who have kids who don't want the house. Like the idea of like inheriting the house is now feeling like a burden to their children. And so maybe that might be someone, and maybe that house is paid off. And I'm just wondering if you could talk a little bit about some of the, you know, smoke and mirrors in terms of like how it's determined, how much money someone will get, and how that all works. Because I know people have a lot of curiosity about that.
Yeah, you're right. About 1% of kids actually want their parents' house because at that point in their life, they already have their own house. So how much money somebody can borrow is based on 3 factors. Age of the youngest borrower, at least one needs to be 62. Both don't need to be 62, but at least one does. But if somebody's younger than 62, we take the youngest age. 2 is the value of the home, and 3 is the interest rate. Interest rates are lower than 30-year conventional rates by probably half to 3/4 of a point. So the mechanics. So that's how much somebody can borrow, and it's about 35 to 45%. So they're
Of
not
the value of their
borrowing.
home.
Yeah, so they're not borrowing 80, 90%. They're borrowing just a fraction of what it's worth.
Hmm.
But the process is this. We usually have a 15-minute phone or Zoom call, and I just get a little information, get to know them a little bit, find out what they're hoping to do, make sure they qualify. They're old enough, they have enough equity, they have the right property type, single-family home, town home, 2 to 4 unit building if they live in one of the units, even condos, we can do condominiums. And then they have enough income. Most people qualify with just their Social Security, believe it or not, because they
Hmm.
only have to show they have enough income to pay for the taxes, insurance, and maintenance on the house. So most
That
people
makes
qualify
sense.
with just that. And then we collect some documents, and usually I sit down with them if they're within an hour of my office, or we'll do it over Zoom, and I just walk through how the loan works, kind of what we're talking about here, what the requirements are, and and what happens at the end, and we can talk about that too what happens at the end if you want, because a lot of people want to know that. And then, they decide if they want to go forward or not. Sometimes they bring in a family member, sometimes not. And then they have to do, this is one of the safeguards, they have to do a 1 hour in-person or phone counseling appointment. Most people choose phone, but they can go in person if they want to. And it's just for a couple of things. One, the government wants to be sure that they understand the program. It's a government loan, by the way, FHA loan. Two, they want to be sure they're not being coerced or abused to do
Yeah,
this.
that's
Somebody's
important.
not trying to take advantage of them. Three, they want to be sure they're of sound mind, that they have all their mental ability to make a good decision. Most people tell me, I didn't really learn anything. Everything you had told me I already knew when I did the counseling, but it's mandatory. You have to do it. So they do it. And then we do the loan paperwork, and they can either sign it electronically or they can wet sign it.
Mm-hmm.
And then we get into processing, where we order the title, order the appraisal, order the payoff if there's a payoff. We update the homeowner's insurance, mortgagee clause. Nothing changes until we close, but we update it so the underwriter can sign off on that, because it's one of the conditions before we can close. Then we get loan approval. Probably appraisal, then loan approval. And if there's any conditions to meet, we meet those. Usually my loans come out very clean because we collect all the documents up front. It's a very simple, convenient, streamlined process for people.
Mm-hmm.
And then we close, and they can either go to the title company or we can send somebody to their home to sign the final paperwork. And then 3 days later, after the rescission period is over, the loan funds on the fourth day. And then the mortgage payment becomes optional, or they don't have to make one if they don't choose to. So let me just touch on real quick what happens at the end, because a lot of people want to know that.
Yeah.
When does the loan become due? When the last borrower moves out, so they've moved out permanently, either they're going to live somewhere else or they've gone on to heaven, whatever, they're no longer live in the home, the loan becomes due. And the heirs or the estate or the borrower have up to 6 months to sell or refinance the house. So if they haven't made a payment, the loan balance is going to increase a little bit every month.
Mm-hmm.
But remember, they're only borrowing 35 to 45%.
Sure,
And
there's still equity.
They're earning appreciation on 100%. So there definitely is money at the end. But one of the downsides is there's less money, because they're using some of their equity to live on. But at the end, last person moves out, they can sell or refinance the home. They pay off the note, the existing balance. Whatever's left goes to the borrower, to the estate, or to heirs. One unique thing about a reverse mortgage is no debt can be passed on to the borrower, to the heirs, to the estate, because it's a non-recourse loan. That's one of the unique features about it. So,
Wow. Kevin, I feel like we just scratched the surface here. I have so many more questions lead to other questions. And so let's pause, and we'll continue this conversation at another time. But I just want to say that I'm grateful to have you as a resource and a reference, who is one of 218 people in the country, to come to, because we hear this term reverse mortgage used very loosely and freely, but not very many of us really understand how it works. So this is great information.
well, I'm grateful for the opportunity, and hopefully it helps your listeners. And people can always reach out if they have questions. I'm happy to chat with them and see if it's a good fit for people. And like I say, it's worth it just to learn about it. Whether anybody does it or not, it's good to know about it.
Yes, great.